What is accounting? Well, accounting consists of three basic activities. That is, accounting identifies business activities, then records those activities and finally communicates these economic events to people outside the business who would be interested in the business. Now the accountant must perform these three activities. 1. Identify business transactions. 2. Record the business transactions in a journal. 3. Classify business transactions in the ledger. We will learn in this course how to record and classify and summarize business transactions in order to prepare accounting reports, such as the balance sheet and the income statement. Financial statements are used by people who are outside the business who wanted to decide whether to buy shares of the company and become shareholders, or those considering to lend money to the business. They will become creditors of the business. There are also internal users of the company's financial statements. Managers in the marketing department may want to know how well the company is doing. In the finance department and human resource department, management in general want to know how the business is doing. Now ask yourself, why are you taking a course in financial accounting? The answer is because when you learn this accounting, you will also learn the language of business. You will understand the business terms that business people use. You probably are aware that business people, when they talk among themselves, they use words that you are not familiar with. Where do these words all come from? They come from the accounting profession. Why are these words different? Well, because they're not English. They were originate from 500 years ago. They are old Italian words. Capisce? Why? Because the father of accounting was a monk called Luca Pacioli. He was keeping the books for Venetian merchants, and he developed this system. He published his bookkeeping system in 1494. He described how you use journals and ledgers. He talked about assets and liabilities, income and expenses, and he summarized it all in what he called the balance sheet and an income statement. Now, the way he did it 500 years ago and the terms he used, he wrote it in the Venetian, the language spoken at that time. And those terms form most of the language that business people use today. Now, I want to talk about the different business activities that a business performs. They are financing activities, investing activities, and operating activities. Now, pay attention to the language here. First, financing activities. There are only two ways that a company can bring money into the company. It can sell shares or it can borrow money. When a company sells shares to people, the purchasers of the shares are now called shareholders. When a company borrows, the amount it borrows is called a liability, and the people who lend the money are called creditors. Now, a liability is also often referred to as a payable. A note liability is a note payable. A bond's liabilities are called bonds payable. If the company issues common shares or stock, they're selling part ownership of the company to people outside the company. Those people are called shareholders or stockholders, and when the company earns a profit, it returns some of the profits to the shareholders. When it does that return to the shareholders is called a dividend. Next, investing activities. Now, investing activities refers to when the company buys or sells assets. Assets are often referred to as resources. The company uses computers, delivery trucks, furniture, and equipment in generating the revenue that they earn. They generate revenue by performing a service or selling a product. Now, revenue is the money that is earned from the sales of product or a service. It's money that's earned. Now, if you sell a product or service and you have not received the money yet for it, you've earned it, it's revenue. But it's owed to you. They are going to pay you later. That's called an accounts receivable. Another asset that is very important to a business is called inventory. You will also be introduced to expenses. Expenses are the cost of the asset that has been used up or consumed to generate revenue. Liabilities, as I said, arise from expenses, and they're often referred to as payable, like accounts payable or interest payable. Now, if revenue exceeds expenses, that's referred to as in that net income. If the reverse is off happens, it's a net loss and trouble. Accounting, you must realize, is governed by a lot of rules and regulations. We call them standards, accounting standards, and we have two major accounting standard boards. One is the International Accounting Standing Board and the other is FASB, which is more like the American Financial Accounting Standard Boards. Both of these standard boards produce what are called generally accepted accounting principles. An important principle in accounting is the cost principle, or sometimes called the historical cost principle. The principle states that assets are recorded at the value the company paid for the asset. So when you see an asset on the balance, that value is what the company paid for it. The asset could have bought 50 years ago. Assets on the balance sheet are not what it's worth today. What it is worth today is called market value. You don't have market value on the balance sheet of any company, you have the historical cost of the asset. There is also the entity principle, sometimes called the economic entity principle or the business entity principle. The entity principle requires that the accountant records in the company records only the business activities of the entity and not the business activities of its owner. Next, I want to talk about the three types of company ownership: proprietorship, partnership, and corporations. There is the sole proprietor. That is a person, one person who owns the business, and most often is the manager. He or she receives all the profits and suffers any of the business losses. The assets of the business are the assets of the owner, but the debts or the liabilities of the business will have to be paid by the owner of the business if the business fails. So that's the risk one runs as a sole proprietorship. If you are in a lost position, the people who are owed money by the business can take your personal assets. Then there is a partnership. A partnership is two people, or more often in a service-type business like accounting or lawyers, generally unlimited personal liability, but it has to have a partnership agreement. But again, it's like the sole proprietor. If there are debts of the partnership that haven't been paid, those who are owed money, the creditors can seize the personal assets of the partners. Now compare that to the corporation. Most companies are corporations. A corporation is a separate legal entity separate from its owners. The people who own the company are the people who purchase those shares. Now the owners of the company cannot be sued by the creditors of the company. If you buy a share in a corporation, you can only lose the value of the share you purchased. So if you're going to lend money to a company, you should be aware of what kind of organization form that the business is. If it's a corporation, then you cannot go after the owners. You will know a corporation because it will have in the name either LLC for limited liability company, or it might be ABC Corp, or it might be ABC Inc. When you see those letters in a company's name, you know that that company is a corporation. Now, lastly, there are three types of companies. First of all, you will learn the transactions of a service company, as they earn revenue by performing a service. The business transactions of a service company are a lot simpler than the transactions for merchandising company. A merchandising company sells merchandise, which they did not produce. They purchase the merchandise from a manufacturer or another supplier. They did not change those goods. They simply put them on a hanger or put a price tag on them. Merchandise transactions are a little more complicated than a service company because you must know how to account for merchandise inventory. The last type of company is a manufacturing company. But a manufacturing company buys in raw material and converts them into a finished product and then sells that product to other customers. So there you have three types of businesses, three types of company, the three types of business activities, and so on. Again, you will know the language of business once you complete this course.